What's up, Theta?
Hey, how's it going?
Good, man. Good. I am looking forward to the chat here. I think this one's gonna be pretty chill. I don't have anything planned for after or anything like that. I think some of the panelists are still gonna be able to come, some not, but I'm just looking forward to talking a little bit about the market here. I do see Josh Young in the audience too, Josh, if you end up wanting to jump on stage. But yeah, Theta, curious to hear from you what you've been looking at in this market so far this week.
For sure. So, first and foremost, what's going on? Glad to be back on the spaces again. Been a crazy day and week so far. Last 2 3 days have been pretty interesting. Obviously, Tesla, the big mover today, as well as Amazon. I traded Tesla exclusively today. Had a nice win to the upside in that. But yeah, I'm continuing to watch some of these blue chip names that have kind of been not having the move that you might expect in a bull market run, like Google breaking out. Like I said, Amazon and Tesla, obviously big move. Apple, started to do its thing last week. So some of these, megalithics are starting to, show the market who's boss again as some of these semiconductors kind of cool off a little bit. I thought it was interesting today, watching the options flow. The market primarily was writing calls and buying some put protection on most of these chip names: NVIDIA, AMD, TSM, Micron, Avgo, Broadcom, et cetera, et cetera. All these names, that we've been seeing perform so well and have been so strong and been leading this market higher. We're seeing some profit taking, and I think it's not crazy to believe maybe we see a little bit more of a pullback like we started to get into. We saw like a 1 day rotation right on Monday when they're selling off tech and they're starting to buy everything else. And then immediately after they come right back into it. So I don't know, maybe with Micron's earnings out now, obviously that's moving lower after hours. Maybe that'll kind of increase the chance that we see a little bit more of a pullback in the semiconductor names, which truthfully I think probably would be a good healthy thing. I think that there are some lower levels that maybe we need to revisit, kind of test some of those previous sellers, see if they turn into buyers, and bring in some new blood into the market in order for these names to continue higher. So I think it's great. We're seeing a rotation within the tech sector almost, right? We're seeing those semi names come off, and they're buying Amazon and they're buying the hell out of Tesla again. So yeah, it's been a pretty exciting week overall, and I'm excited to see how the rest of it shapes up.
Appreciate you kicking us off with that there, Theta Warrior. Definitely looking forward to seeing how the rest of this week goes as well. Uh, Real quick, Emp, you headed on vacation next week? You gonna be gone Sunday? We're gonna do some futures Sunday night.
I'm flying out tomorrow.
Oh boy.
Headed back home. Got some on-site business stuff to take care of and handle back home. But weekend I should be completely free. I'll be staying at my parents' house back home, so I have zero plans that I'm aware of. So should probably be able to jump on pretty much anything outside of normal office hours.
Good stuff. 6 p.m. Eastern, by the way, guys. On Sunday night, we're gonna do a futures educational space. So putting that one out there. All right, let's keep it going up here. We have the return, the man, the myth, the legend, Jaguar, back on spaces, ready and refreshed. What's going on?
Good afternoon, everybody. How's it going, Wolf? It's been a long time since I've been with you on Spaces. Well, at least 3 weeks. So I hope everybody is doing well. I'm glad to be here. I've been on the road. I've been traveling. I've been all over Europe. Been to 5 different countries. It's been very fun and exciting journey throughout in the month of June. So just came back to my desk on Monday night and immediately went straight to work. In fact, the day when I came back on Monday night, I was in my office working until 1:30 in the morning. That's Monday night, Tuesday morning, just trying to catch up with all the research that my team was doing behind me and many other things that were just pending, waiting for my approvals. And that continued throughout on Tuesday and then today as well. So there's a lot to digest. There's a lot of gaps in my knowledge from the last couple of weeks because I was not involved in the market as much. And so just catching up to the news and so many different things. and getting back in the rhythm. But yes, glad to be back. Um, I don't know how you want to continue this discussion,
Well,
carry on
well,
this conversation from here, but let me know when you want me
yeah.
to.
No, let
Yeah.
me just throw it over to you right now. Walk us through what you like in this market right now. I know you've been away, but I'm sure you've still been keeping an eye.
Yeah, so there's tremendous amount of research in the last couple of weeks that as I've been catching on to, and there's fundamental work that happens in Jaguar all the time, but then we wait until the technical setups are there with the fundamental background already in place when it's time to strike, when it's time to actually execute trades on the bullish side or on the bearish side. And I'm very active. In Jag, we're very, very active. We go both ways. And we have said this many, many times that we're never dogmatic about, that you have to be always just bull, 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 or just bear all the time. There's no such thing as perma bull or perma bear. You have to be flexible enough to take advantage of the news flow and the opportunities that the market presents on both sides. And I oftentimes in my own portfolios I have bullish and bearish positions open at the exact same time. And so that's how we approach things. So right now, that's exactly the dynamic, because when you look at it from a high level standpoint, the S&P has been flat to slightly higher, but it's been largely supported by the large cap tech stocks. Today was another example of that. But underneath this tape, if you'll do the relative performance of all 11 S&P sectors versus the S&P itself, you will find out that 9 out of those 11 are materially underperforming, really since April. March, actually, I would say since March, but then they have been extending those losses on a relative basis versus the S&P really since May. On 9 out of those 11, the two that have been hanging on tight and continue to push higher and outperform the S&P is infotech and communication services. And in communication services, we get into Google and Meta, and so those are separated from infotech, and that's how that particular segment is supported. So what this does is that within the market, even when you are bull and the indexes are holding up nicely, you have tremendous number of shorting opportunities along with it at the same exact time, because you're seeing charts break down. You're seeing stocks actually react to bad news, um, and increasingly, mainly because of the function that the Fed has maintaining this bias of staying higher for longer. And so the old school ideology, which we saw throughout in 2023 and in the early part of 2024, when every bad news was seen as good news, because why worry? Because the Fed will pivot soon anyway. That has slowly gone away in the rear view mirror, and bad news is actually bad news, and it is hitting stocks. And many, many groups, in fact, from transportation to industrial to retail, and just many of the consumer discretionary name. And you're seeing names like Celsius Holding go off, basically fall off a cliff. Lululemon has gone off, completely nuts in the past 6 months, constantly making lower lows. You've seen many of the other growth areas of the market, just basically continue to make lower lows. So you have very bifurcated market, and it's been a function of market paying attention to bad news being just bad news rather than just believing that why worry when the Fed was going to pivot all along. Fed pivot is not coming. In my opinion, there will be no rate cuts throughout this year in 2024. If we are lucky, we may get one, maybe around election time frame, but that's depends on unemployment. In my opinion, what happens to the unemployment rate in the upcoming upcoming NFP reports, but that's to be decided. The data will tell us that. But for now, I'm with the view that there will be no cuts this year at all. And I think ultimately that is just going to continue to weigh on certain cyclical parts of the market. And you're seeing this in many, many sectors already play out. So Let me get into a couple specific names here, as I typically do, and give you my high level views as well as my more micro views on certain of these names. So, for example, if you pull up the name like Polaris, symbol PII, this is a company that makes the boats as well as ATVs and snowmobiles. This is a consumer discretionary stock that is highly correlated to the interest rate environment and overall consumer discretionary environment. And oftentimes, when the discretionary environment is slowing with the rates being too high, such as the case right now, these are the type of groups that basically just get slaughtered firsthand. And until the rate cutting cycle begins, they just continue to go lower and lower and lower. You're seeing this in Polaris Industries, PII. You're seeing this in Brunswick, symbol BC, which is another boat maker. You're seeing this in Mastercraft, which is MCFT. That is constantly breaking down. Another breakdown today. You're seeing this in RV makers such as WGO, which is Winnebago. You're seeing this in Thor Industries, THO, constantly making new 52-week lows, CWH, and there's many others like this. So just this morning, we basically looked at some fresh channel checks related to this, and we posted this in front of our clients. And we said that if you look closely, you'll find out that Winnebago reported its net sales down by 13% year over year to 786 million a couple days ago, missing the street expectations of 798 million. And the guidance is now calling for down mid to high single digits year over year. From a segment perspective, motorhome sales down 20%, driven by a 21% decline in units. Marine sales down 32%. I mean, these are just god awful numbers. Within the RV industry, the retail recovery that management originally anticipated that would begin in April-May timeframe is not occurring as rapidly as they had thought. Demand remains soft as buyers continue to navigate a challenging environment in the high interest rate environment. When you further break it down, now you go to Polaris, symbol PII, and you go to the SEC filings and you pull their 10K report from there. And there you see the marine segment designs and manufactures boats that are designed to compete in key areas of recreational marine industries, specifically in pontoon and deck boats. And according to statistical surveys, the US powerboat registrations fell by 10.2% year over year in the month of May. And this would bring the year to date decline to a 6.3% rate, meaning sequentially the data is only getting worse. Year to date, the powerboat sales are down 6.3%, but more shorter term, which is the most recent month of May, was down 10.2%. So sequentially, it's only getting worse and worse. And as a result, you're seeing that the street is constantly revising and forward estimates lower. Break it down further, you'll find out that aluminum boat sale registrations in the US are down 8.6%. The aluminum fish sales, which is the aluminum fishing kind of a boat, specific type of boat, that's down. Pontoon boats are down 13.2%. Fiberglass boat sales are down 12.5%. Ski and wake segment, which is very much relevant to Mastercraft as well, is down 22.9%. Across the board, the data just looks bad. Now you pull up the chart of PII, and it's about a month away from reporting earnings. And these are the channel checks you're presented with. So, what should we expect from a name like this to report the next time when we see the data point? And it is getting read through from Winnebago, WGO, which was just 3 days ago. Same thing, you pull up the chart of BC, Brunswick, and what do we see in the data there? What do we see in the chart? These charts just keep breaking down nonstop, day after day after day. It just keep going lower. And the longer the Fed stays high with this higher for longer theme, with the rate cutting cycle to begin anytime soon, right? And if the whole year goes by, there's no cuts. These are the type of consumer discretionary name that will just continue to get hammered. Today, we saw in XLY, which is a consumer discretionary ETF, somebody started to buy March out of money put options. Now, it's not a big bet. It was a very small bet, but it is an unusual name or unusual flow for an ETF in which we do not really see much of the action, but something to keep an eye out. Recently, we started to see similar kind of put buying pick up in home builders as well. And if you pull up the chart of ITB, which is the home construction ETF, or you pull up the chart of XHB, you'll see same kind of breakdowns are starting to happen there as well. Anything that is big ticket purchase item that is dependent on the interest rate cycle is starting to show increasing amount of signs that bad news is actually bad news. They're reacting accordingly. And you're seeing this in these charts. So that's the first name. And by the way, feel free to stop me anytime. Otherwise, I'm like this energizer bunny that will just
No,
keep
no, I
on
know.
going and going and going.
Well,
So
let's get one more point in, and then I'll bring in some others. We'll go around. We got time to hit everybody.
yeah, and then so the second thing that I will mention is in this particular case something on the positive side of things, and I'll go to a company that will be reporting earnings in a couple of days, and that is Constellation Brands, symbol STZ. Constellation Brands. Now, this is the company that owns Corona, the beer, Modelo, and a whole bunch of other kind of beer brands. You probably have them in your house, and you probably drink them all the time. When is the earnings report from Constellation? In this case, I think I'm showing here July 3rd before market opens. So that would be next week sometime. The stock had a big rally, came off the downtrending resistance line, has been forming a bull flag, consolidating between 260 and 265 level for the last couple of days. I expect this to break out and make a run towards 270 to $275 per share, with potentially this earnings report next week providing that specific catalyst. And the reason for this is once again where the channel checks are pointing out that in this case, you're seeing much stronger data for for Constellation Brands beer depletion history. Specifically, there was a note out from Citigroup combining that with the scanner data that came out from Nielsen. We are looking at the consensus estimate for beer depletion is about 5.3%. We believe that number could be north of 5.5%. But even if it is just in line with estimate, considering we are coming off a period where the year over year comparisons are pretty tough for the company, considering last year was pretty strong, we believe that even a 5% print on the beer depletion side, with company just reiterating its fiscal year 2025 guidance, may actually be sufficient enough to lead to a technical breakout in the stock. And that's how you get a move above 265, and maybe we see $275 per share. So we like the name going into this one. I cannot say the same thing about spirits. There has been actually a weird set of channel checks that we have seen lately. It's not very common, where we have seen spirits, which would be something like Diageo, right? They're not doing very well because they continue to get hammered, particularly in South America. But over in the US, spirit sales are good, beer sales are even better. And I think going into the July 4th
Yeah.
holiday, there could be some another spark that could go off from there too. So overall, going back to Constellation, 5.5% depletion rate on the beer side is what we're expecting. And I think if we get that print with even guidance reiteration, that's sufficient enough to lead to a technical breakout in the chart. And if we get any kind of rotation in the market along with it, we have already seen a couple times where we have seen the growth basic from growth to value rotation. Essentially, you saw one glimpse of that on Monday as well this week. If we get one of those rotationary periods again, that would also be very supportive of a technical breakout, not only in this, but also a whole bunch of other consumer staple names such as, I don't know, Procter and Gamble, Kimberly Clark, and many, many others that fit that definition, Coca-Cola, and so on. So I like this name going into earnings. On the bearish side, Polaris. I do have a couple other names too, but let's go around the room. And
Yeah.
when you come back around, I'll touch on a couple of those.
Sounds good. And if anybody has thoughts on stuff that Jaguar covered too, feel free to jump in with that. And also, I'm just going to go around, but if you guys want to jump in sooner or have a thought, you guys can always raise a hand and I'll come right over to you. But not seeing any hands raised just yet, I'll come over to Shy, my other co-host here, get, any thoughts that you might have on what Jaguar or Theta shared there, and then whatever you're looking at in this market.
Yeah, so I'm going to be talking tech. That's definitely my lane. So I do on a this is tricky. I'm very much a micro investor, so I'm stock picking. I get real in the weeds with my specific holdings, and also any of the prominent names in the data cloud, AI, and e-commerce world. So I did notice like not a transition, but a lot of the software is dead narrative that started happening a month or so ago caused a huge sell-off in this a lot of the software names. So like the Cloudflares, Atlassian, Snowflake, MongoDB, the list goes on. Like they're getting destroyed. And the earnings also didn't help them as well. But it just got to a point where it was just way oversold, and you started seeing certain names catch a bid last week. Where Atlassian caught a bid at 154. Cloudflare filled that gap real quickly on what they're when they gapped down into the mid 60s, and now I think they hit $80 today. You're also seeing Datadog show bounce really easily, and then I was like, oh, I called out to my followers and also my subscribers, like, all right, you're seeing Atlassian getting bid up along with Cloudflare and other names. I do think Snowflake, MongoDB, and Unity specifically are way oversold. If you look on the daily chart, I mean, MongoDB was like a 16 RSI at one point. If you guys don't know what RSI is, it's a relative strength index. Usually anything under 30 is oversold. So MongoDB was at 15 at one point, and even 2 days ago, it was like in the mid 20s. And Unity was also in the high teens as well. So it's like these aren't shitcoat companies. This sell off in these specific names aren't thesis breaking where software is dead or AI is going to replace them. It's more of a valuation compression due to the tenure, the chances of a rate cut from 2 to 3 is looking more like 1 to 2. So growth tech will get affected by that, as well as you're not seeing that immediate Gen AI pickup into their earnings. So there's going to be a lot of FUD that gets thrown in because the adoption component of AI starts from the infrastructure stage, eventually goes to the application stage. But during the infrastructure to application lag, there's always a lot of FUD of these like growth names where the bigger players are just going to create replicated products and create this similar narrative that why should these software names like have any place in the modern tech stack? Like the same argument happened when cloud got generated, where CrowdStrike, the biggest argument of CrowdStrike a couple years ago was like, how can they compete against Microsoft? You're seeing what CrowdStrike has done since then, and you're also seeing the same things on like a lot of these software application names who ran up a ton, like Trade Desk. Same argument, like why would you invest in an ad tech company outside the wall gardens? Like that doesn't make sense. The big three are just going to dominate that space. We're seeing how Trade Desk has performed the past couple years. This narrative has always been there, and also like it happens like once a year. It's kind of wild where the narrative in software gets absolutely bearish to the extent where it's just wow, it's over exhausted, and we just experienced that what I believe was 2 weeks ago. And you're seeing names today like indices are flat, but look at Tesla's up 4 or 5%. Look at Snowflake. Snowflake was up 5% on decent volume. MongoDB was up 6%. Atlassian now has gone up 10% in the past week. Like I know this might be short lived because these software names are in a place where they kind of have to prove it that the lack of ARR, the lack of billings can't just be made up from the RPO. It actually has to result in some decent guides up, and a lot of the software names most recent earnings cycle, like they had really weak Q2 guides, but they bumped up the full year, but not to the extent to make up for the two Q2 guides. So I do think this dead cat bounce we might be seeing in software names might be short lived. It depends on how the velocity of this bounce, because the chart is broken on a lot of these software names, and the next catalyst is their earnings in a month or two. So that's going to be the proven moment of, will this be just a dead count bounce? A lot of these names are kind of below their 200-day moving average. So if you guys don't know, that's a stage 4 component of this technical analysis, where that's where the most pain occurs. And a lot of traders actually, once the stock gets into stage 4, they bounce. And it makes sense because that is where all the pain happens. We've all experienced it in 2022. A lot of money could have been saved if you just exited your position, went defensive. Once these tech names broke that stage, got into stage 4 and broke that 200-day moving average. So that is the interesting component of being a long-term investor, where I'm still bullish these names 5+ years, but I am cognizant of the near term would be difficult, and any kind of balance I could see being short-lived due to that proven component in their earnings. But I love what I saw today. I mean, there's certain names I got in, like even though I am a long-term investor, I'm not going to be deploying all my cash into my DCA strategy anymore. To my the MongoDBs, the snowflakes, that last instance, because I'm overweight in all these names. I've added a ton in the past month or so. So what am I going to do when I believe I'm part of the camp where they won't go up as much as I think they will because of that prove it component in their earnings? I'm against some technical setups where Mobile Eye is a great example. I called it out yesterday and this morning, where this chart looks really interesting as a short squeeze candidate. I could see a simply play on Rivian's announcement yesterday with Volkswagen on kind of like a picks and shovel play on autonomous uh, driving is Mobile Eye. So I could see a short term bounce, but it's also going to be a really short term play. Like I did, I think it was August expiration and July, just because Tesla's 8/8 event, I do think is going to be a massive headwind for a name like Mobileye, because their technology is so far behind of what FSD is that they're gonna have to get some juicy partnership down the line, or b innovate rapidly, which I don't think it will. So I do think that's a massive headwind for a name like Mobileye, but I do see this name potentially going to $32, $33 when it was at 25, and today it's up 8%. Another one's Robinhood, where it bounced on the 21 EMA, and this is a cyclical play where you're seeing that strategy of getting those assets under their platform due to that 1% match and the retirement initiatives they caused. A ton of money is going on their platform, and I don't know if about you guys, but once I have a money in a brokerage, it is the biggest headache to get it out and switch, because of there's so many components of it. It's really difficult, and that's why these brokerage models are stick. I don't love the brokerage business model, but it is very sticky. And Robin, if they get all these assets under their platform, like I do think these dollars will stay there at least a year. So I anticipate they having really strong earnings again, and especially with crypto, what I believe is going to be raging in July. That's a good sympathy play. So I got in, and it's done well the past 2 days. So I'm being very I'm being very short-minded on my soldiers now, on the dollars I'm using on these trades to juice up, or um, get some kind of alpha in the near term, knowing that my long-term conviction plays won't nothing will happen to them in the near term. So I want to raise my cash balance by making these trades in order to have enough dry powder. Because if this upcoming earnings cycle is as brutal as the previous two have been for software, I want to be able to be ready to add to these long conviction names, because I do think the sentiment around software sh- it's just very temporary. Vast majority of IT budgets is going towards AI related infrastructure spend, and eventually it's going to revert back to applications, which is where software makes their money. I just don't know when that's going to happen. We won't know until the big tech players kind of give us some kind of visibility in that in a month or so. But I'm underwriting a Q4 outperformance on these software names, so we'll see if that happens. But yeah, I'll pass it back to you. It took a lot of time, but that's kind of how I've been playing recently in the markets.
Yeah, Jag.
Yeah, I have a question for Shai. Um, in your opinion, do you think AI is disruptive? Do you think AI is disrupting the enterprise software space um, in ways that is not fully modeled into consensus view? Or do you believe that it is more complementing the space um, with the build out that is taking place? And what I mean by that is, we are automating so many functions that would require consumption trends, would support strong consumption trends of cloud. And I wonder if that is being disrupted by the automation in ways that will only over time result in rather lower growth profile than what we have seen historically in the enterprise software. I mean, Adobe, for example, comes to mind, where so many of its functions related to programming or related to creating design studios and many other things. Is AI disrupting that along with data collection, data manipulation, and anything that we think about in the enterprise software space? Just a high level view on that.
Yeah, I think it's highly disruptive. So that's why I'm being very specific on which software names I'm investing in. Where a lot of them, I'll give you some examples. A lot of the seat-based business models in software space, I do think will be disrupted, and they have to slowly, eventually transition to the consumption base because there is going to be a headcount reduction at the enterprise space due to AI. It's inevitable. Teams of five will turn to teams of four, will turn into teams of three. So I think that those kind of companies, like the CRMs of the world, like the Klavios, the Asanas, you're seeing with Salesforce a little right now. Those type of CRM business models will be disruptive, and they have to. There's gonna be a massive consolidation. And right now, you're seeing Monday.com doing well in the mid markets, but I don't know how if Salesforce will start disrupting them, or there's a lot of these CRMs will just start getting, in my opinion, will get bought up by the bigger players. Like Klaviyo will get bought up by Shopify. Monday.com might get bought up by Salesforce. Asana might just go private. Like I think that's the way the CRMs are going to go. The DevOps tools, as is another great example, will get disrupted. GitLab is a great tool, but essentially AI is a great assistant on generating code now. You still need GitLab, but you don't need as much as you would think in a couple years. That's going to be another example. They're going to get acquired by Google. GitHub is king in that specific realm, and I think maybe there's a player for as a sidekick in that specific sector, and that's why GitLab will just get acquired by Google, and Google will be number two. But that specific area as well is like, oh god, that's gonna be disrupted. JFrog's another one that might be disrupted as well. So the way I'm looking at software is like you can't just go based on traditional metrics like ARR, dollar-based expansion rate or net retention rate, or even RPO, because RPO is just inflated right now due to, like I called out earlier, the bigger weight of IT budgets is going towards the infrastructure spend. So RPO is just getting bumped up. It's just very short lived and it's misleading, in my opinion. Uh, so you can't just go off those traditional metrics anymore for next year or even 2 years because you have to go dig deeper. You have to look into the code, look into the actual product. Like, can this be replicated? Because AI will generate a lot of replication on existing products right now into a bigger suite of products. So the Mag 5 names or the big tech names, like they're going to be able to create replications of a lot of products that to the point where being cloud agnostic won't matter as much. That's why I downgraded Datadog recently. I think it was a week ago to a starter position. I took the gains on it, reinvested into the names in the software space where I don't think will be replicated and will have a player place in the modern AI tech stack. But observability, the way Datadog makes money is if companies overspend and they identify the error and they make sure they become more efficient. I could see that specific realm of software kind of going fading away or becoming replicated. It wouldn't take too much AI or code to replicate a Datadog competitor into some bigger suite. And the private market of what Datadog does, even public market, is highly competitive. So I think the ceiling on Datadog is a lot lower than I used to believe in when I initially initiated the position 2 years ago. For that reason, I want to downgrade to monitor how they can how they're going to go in the next couple of years. Like you have to be very picky on it, and as soon as you see any kind of weakness, in my opinion, on commentary where you're seeing certain software names get that Gen AI bump that you haven't seen in your own position, I would I would monitor that name. Like right now, for example, I think Snowflake, MongoDB, like these database companies and data warehouses, like they won't get replicated, in my opinion. Like there is gonna be bigger players. Like the Oracle is a massive bigger player, but I think NoSQL function of what MongoDB does in the vector search will be the future of the modern AI tech stack. But it's taking a lot longer to do that because the way their database is, it's transactional. A lot of applications use it, and right now it's still tough, the business spending. It's we got a head fake 3 quarters ago that business spending was behind us, like the business spending recession. That's clearly not the case. And even the C-suite on all the calls and software, they're calling it out. Like it's still like we're still not great, and we're not confident in guiding up in the near term. But we're anticipating a Q4 pickup or a second half of the year. So I think MongoDB and Snowflake, especially Snowflake, with 35% of the Fortune 2000 data stored in their ecosystem, I think their product oriented CEO can leverage some go to market AI products to leverage that amount of data to become a necessary component of the modern AI tech stack. That can't be duplicated. Palantir has no competition in what they specifically do. I still believe they're going to succeed in the commercial side. We haven't seen it. We haven't seen the commercial client growth get reflected in the top line growth yet for what I believe is it's a heavy capex, and a lot of C suites aren't giving the green light on these kind of $50 million plus capex spends until they feel confident the higher for longer narrative won't be there for that much longer. And as soon as the Feds cut rates, I do think that'll give them the green light. Okay, the worst is behind us. We can start being aggressive with our investments towards our capex. So I think Palantir again won't be replicated. Elastic is ticker ESTC, that's an interesting one where it's in the gray area where they're part of the infrastructure of the data, but I could see their search function of like the data ecosystem could be replicated down the line. We're just not seeing it right now, but they're seeing a Gen AI pickup, right? Like, they're one of the few software names this recent earnings cycle where they called out the Gen AI pickup that was reflected in their earnings, and I want to see how that plays through. So that's my watch list, but I'm sticking with the. Hopefully, that answers your question, Jag. I think the software industry will go through a massive consolidation. These companies won't go to zero, but they're going to go the route of a Twilio, who will just be dirt cheap until they go private, or the HubSpot, where bigger companies will just want to acquire the CRMs to get the data, the amount of data they have on their platform, and infuse it with their current environments.
Yeah, it answers the question. The reason why I asked that question is, oftentimes we have seen whole sectors, starts to go out of favor. And it's very, very difficult to know with the sea change that is taking place as to how long they will stay out of favor. And there have been moments in time when the they have stayed out of favor for much longer than anyone could handle, because the multiple contraction story, when it starts to hit certain areas of the market, it doesn't end on a dime. It can continue for a very long period of time. And I can tell you that, as one example, when there was a moment, and this is a different industry, but I think you can sort of see the views that here, and sort of apply that to many other industries. um there was a time, for example, in oil and gas space, when the US shale boom was taking place after GFC 2008. that throughout from that time, 2008 to 2013 to 2014, for good 5 6 year period, stocks were being rewarded for spending on capex. If you go back to that period, during that sixth period, 2008 to 2014, you would see that if a company like Pioneer Natural Resources or EOG Resources came out and said, we are increasing our capex on drilling, that was that was the narrative market wanted to hear, and they would bid up on, even though higher capex means your free cash flow is, you're draining the free cash flow, you don't have that excess capital you're generating, right? Which means you can't shoot dividends or aren't, or none of that, you can't do buybacks. But the market loved the spending story. Higher capex, your stock goes up, until it played out to a point where multiples just became obscene and overcrowded, and excessive started to build into the system. And then became a period when it was a very prolonged period of rig counts that just continued to get cut. I think the US rig count peaked at 1900 in 2014 and it bottomed at 400 8 years later in 2022. It was an 8 year long bear market that unfolded. And during that time period, when the sector went out of favor, you saw the smaller uh, players with weak balance sheet got wiped out, and the bigger ones saw multiple contraction that just kept happening and happening and happening, to the point where people just started to give up entirely, like it was done, right? The reason why I'm saying that is if we believe that this AI is truly a game changer, it is a if it is a story that is going to force significant changes in how software is built and consumed by enterprises. That means when now you think about the excessive valuations, where, if you go back to just before pandemic, right? Go back to 2018 and 2019. You could have bought any enterprise software stock any time in the past decade leading up to the pandemic for 7 to 8 times sales. And now we are dealing with, despite recent corrective phases in the market, you're dealing with in an environment where the software has become a new normal, is 15, 20, 25 times sales. And we're talking sales here. We're not talking free cash flows, earnings, or any of that. So the what I'm wondering is that if this AI is disruptive force, that is a very long-term disruptive force, that will cause the automation in such a way that the multiple contraction story will keep hitting the sector over and over and over again for a long period of time. Seeing where the end of all of this is for the enterprise software is very, very hard, and we could be in the very early phases of it, especially if we start pulling all of this IGV components and start applying to them 7 8 times sales, forward sales estimates 2 3 years out on a lower growth rate. I mean, these stocks may still not be done. That's the concern I have, that the multiple contraction story could still send them far, far lower than what we have seen so far. And that's why I asked that question, that seeing where the end of all of this cycle is very hard from where we sit today. I hope I'm making sense with all of this connection that I'm talking about. But back to you, Wolf.
Yeah. I want to make sure we get to Frank and Emp, and then we'll take any other hands or thoughts. But Frank, you want to jump in here?
Yeah, how are you? Welcome back, Jaguar. Um, I agree with Jag that the consumer area around the edges is breaking down. But as most of you guys know, I have a long-term positions. And the most important, we never really talk about this. I'm going to go through it pretty quickly. I'm going to use Apple as an example. Apple bought 165, 185. Made a great move. When do you sell? So it depends on age. It depends on if it's a long or short term. I'm 60 years old, so everything's short term for me. And I have, certain my portfolio has changed over the years. It's gotten a little more conservative, and with rates increasing, I can gather 10% almost anywhere, so it's pretty inviting. And I trade NQ during the day and some other stuff, and do some swing trading. But like Apple was probably one of my bigger trades in the last 6 months. 165, 175, 185. When Apple broke through 200 and went to, the target was 250, and traded at went from 200 to 220 in a minute. Like, price does matter. I bought July, August, September, sold July, August, September, um, 230s and 240s and 225s. And like, if they take that away from me, that's okay. I'm like a happy guy. So in a market that's like on fire like we have, when do you sell? Nvidia a week ago Wednesday traded at 140. Now, Nvidia long term is a terrific stock. It's probably going to go much higher, but there will be substantial correction phases. And as traders and investors, you have to recognize that. So the lower high was today at 130. So Nvidia's gone through a big move on the upside. So now, like we talked about, and we always talk about on Spaces, it's going to rest. It's going to have its resting phase. But you can probably lean on it when it goes up. When do you sell it? That's depending on your time frame and a lot of other things that as individuals, you have to look at. And I know portfolio managers are looking at. I know specifically a lot of guys that were laying into it last night at 129. Some covered this afternoon. Some are still looking to continue to sell and get short for a trade. SMH, I said it last Thursday. I mean, these are trade setups. Like I said, there's a big gap below. There's another gap below this. And we had a nice bounce in SMH from 255 to 261. It was looking like it was going to run this afternoon until Micron earnings came out. So, I think the market will have a little better picture of it after GDP tomorrow. And I think Jag's 100% right. Bad news is bad news now, guys. If we get a hot PCE number on Friday, if it was really hot, guess what? Correction begins. I mean, it's kind of like you kind of have to keep it simple. July is the strongest part of the year. If we don't finish this month, I was hoping for like a sell-off into July 4th and then a rip into the next part of the month. I think that's the kind of scenario we're all looking for. I don't think people would like to see a sell-off. I'd love to see one. Whether we see that or not, we'll see what happens tomorrow and see what's in front of us. My
If I
portfolio is much longer term, but short term, these are all things, and you can't just buy stocks and buy the dip. And at some point, there's times to make sales, or you look foolish. And people should be thinking about that when they're looking at their positions, and when stocks are dropping like rocks, some of them around the sides and around the edges. Besides the big seven. Those are just my thoughts.
Yeah, and I just want to quickly touch on that, on this very line that I used to start off the spaces, where increasingly bad news is bad news. Very different than 2023, when bad news was always seen as good news because everybody was with the view the Fed will pivot, so why worry? But the Fed has gone too far. I've been saying this for a while. The Fed needs to start cutting now before it's too late, because reversing it will become extremely difficult the longer they stay. In fact, I've been very vocal about this. The Fed needs to start cutting now, but my views don't really matter. But I just want to give you one glimpse of it. Just this week, we had the month of May housing starts came out down 5.5%. Consensus was looking for an increase of 0.7%. Disaster. We had US building permits, which is a leading indicator, came out for the month of May down 3.8%. Consensus was looking for an increase of 0.7%. Bad. We had the Dallas Fed manufacturing came out minus 15 at the same time, too. And guess what happened? All of that bad data, housing related, pushed the 10-year bond yields lower. We were down to almost 4.2% because it's bad data. Previously, even just until 3 months ago, 4 months ago, when bad data pushed the longer duration bond yields lower, you would have seen a bid under housing stocks, despite having bad data. You would have seen a bid under even auto stocks, General Motors and Ford. You would have seen bid under everything that is interest rate sensitive. Not this time. You saw actually all the entire housing complex actually sold off sharply. And along with it, you saw Home Depot and Lowe's also sold off sharply. That was yesterday. And I tweeted about this. There's something here. If you pay attention to the price, what is ITB and XHB trying to tell me? And before that, you were seeing this in April and May in industrial and the transportation sector as well. Increasingly, it is becoming evident to me that bad data is resonating and stocks are reacting to it. But the indexes don't reflect that. Today, again, was a glaring example of that, where the New York Stock Exchange was showing 2.2 decliners for every one incliner. So basically, about 70% down volume. But the indexes were flat. And you've seen this multiple times because it's being held up by the large cap tech stocks. So it's a bifurcated market. And as long as the Amazon, the Googles, the Apples can continue to power higher, it can mask this weakness underneath. But ultimately, there comes a point where things do get synced up accordingly along the way. Everything basically gets synced together and the correlations start to tighten to 1x. That's when VIX gets jumpy. And this is an election year. Be mindful. Anything is possible. Anything is possible. We have debate tomorrow as well. So sorry about that rant again, but who's next? Go for it, Wolf.
Yeah, let's make sure we get a chance to get Emp in here, and then we'll get the hand from Josh. Go for it, Emp.
Yeah, first off, I was just watching Tesla's YouTube channel got hacked there for about the last 20 minutes, running a crypto scam. That was interesting to see. Um, Great move from Tesla today, but that was interesting to see them get hacked on YouTube, and it lasted about 20 minutes there. I think they just got it resolved. Um, no, just as far as trading, I mean, I've had one of my best weeks personally, um, probably if not ever, at least of the last several months. And looking at why, I mean, we were just grinding, making all time high. And for me, trading wise, it's just tough, right? That for me, I just within my strategy, it just doesn't work for me. So I just kind of took a step back and was waiting on a week like this week. And what I've been watching is we fell out of last week's range and then we've reclaimed it and pretty much respected it pretty well. So good day today. It was interesting to see semis tugging the market down while the rest of the mega caps were pulling up today. That kind of went into my thesis of a range day today, and we got that, um, pretty much right on point there, where it would just continued to bid at the bottom and sell at the top. So. Um, yeah, I don't know if I have a whole lot to add to what's already been said. I mean, we've uh, we've seen we've seen this crazy market continue. Where if you look at the data, especially for the S&P, the July is the strongest month over the last 3 years. It's if not the strongest, it's one of the strongest times. We have the earnings season is going to fire up here in about 2.5 3 weeks. So we'll see how that goes. Obviously, an election year. I mean, there's a lot of context to keep putting with all of this. It is interesting, on the macro side of thing, seeing like today we saw Dixie, the dollar index, and yields pop really hard to the upside, but the market was pretty unfazed by it overall. They didn't seem to really care as far as the broader market goes. So interesting stuff going on, and then of course around the world, there's a lot of interesting things happening as well. We saw there's a coup d'état in Bolivia right now. It looks like it's calming down a little bit. I'm watching a live stream on it, but yeah, that's about all I have as far as I mean, I can talk trade strategy, trade psychology, all that all day long, but as far as just setups and market in general, it's a strong market. There's still buyers here. I mean, there's a lot of buyers willing to keep stepping in up at these levels, and but we're not really seeing any change of behavior. Nice to have Jaguar back. I enjoyed the pictures, Jaguar, and I'll throw it back to you, Wolf, so we can hear Josh's thoughts.
Sounds good, man. Yeah, it's been a great panel. Josh, what's on your mind?
Nothing much, man. I thank you for the panel and the space for sure. I just wanted to touch on the AI movement, not from a stock perspective. I'm more on the IT side. I'm a cybersecurity expert and who's now focusing on AI development and things like that. But I just wanted to say that, like what Shai was explaining. I'm sorry, and if it's Shay, sorry if I'm saying your name wrong. Um, is that it's spot on, and one of the things that is so great about something like Snowflake and for instance Microsoft and Palantir is that they're taking their moats that they have and they're exposing it to the AI world, but they're not doing it in a lame way. They're doing it in a way that exposes the technology and really puts fire under the ability for companies to adopt AI easily. And where the benefit comes out of that is that they have all the customers and they can learn from that rapidly before anyone catches up. There's going to be other companies that innovate and try to catch up, but there's going to be a lot of losers, as Jaguar was was explaining as well. And I think Shay really made a good point where any bad news is bad news, and you need to pay attention to when companies aren't performing. For instance, Qualcomm completely missed the mark on their chip on their chips. They missed all the benchmarks that they needed, and that this has weighed their stock down. I mean, I made a lot of money off of Qualcomm this week, and from last week into this week, just shorting that position because the benchmarks that came out for their processor missed the mark of what they need for the Windows laptops and the other laptops that they were going to be installed on. So we don't know what the implications of that is yet. Qualcomm hasn't really released anything official in a way that makes the market feel better. But when there's bad news, you have to pay attention because the market will move very fast and in a very negative manner. It went from 230 down to 200 in like 2 to 3 days. And that's really all I have to say. Again, great panel. I think you guys are hitting the mark on what you're saying. And it's really on the technical side, it's really about how these companies are going to enable other companies to benefit from AI. Because it's going to be the other company, is going to be the companies that adopt AI into their infrastructure and into their efficiency processes that really benefit and start clearing better margins and gaining more customers and better customer service and things like that. I do. The only thing I disagree with is I don't think that the employee market is going to go from 5 to 4 to 3 very rapidly, but it's something to pay attention to. It's going to take some time because no one really understands how to adopt AI into their company yet, and it's going to take a significant amount of time before the trust is there. And I think it's going to be more like the companies grow, and instead of their employee cost going up, it's more adoption of AI, and that's where Palantirs and Microsoft really benefit from allowing that ontology to really speak volumes to the businesses that they service. And that's all I got to say.
Yeah, Jack.
Yeah, well, I don't know how much time you have, but I wanted to switch the topic and ask the panel a simple question and wanted to hear what, if anybody has an opinion on this. And it's about elections. So, do we have time a little bit?
Yeah, we probably got like maybe like 10 minutes.
Yeah. So, I have a election hedge in my portfolio, which I actually just bought yesterday, and that is in SPY. I have 525, 475, 450 skip a strike put butterfly spread that I bought for $4.80 yesterday. Meaning that, and this is in November, expiring in November. That's 525, 475, 450 skip a strike put butterfly. And so, if this market sells off 10%, from now until expiration, November, or even 15%, the trade will produce basically almost 10x return, depending on where it lands and by where and how much time I have to the expiration. But so this is my election hedge. But here are the simple facts, because I think that people have varying opinions on this. This is all in the history, and you've been through this. The last election was in 2020. What happened in 2020? COVID, shutdowns, market crash. Go back before that, 2016. What happened in 2016? Oil crashed from $70 per barrel to $23 per barrel. Healthcare stocks sold off because Hillary Clinton opened the mouth about potentially nationalizing healthcare. S&P sold off 17% in 2 months. That was the election year, 2016. Go back before that, in 2012. What happened in that US presidential election year? European Union debt crisis. Bond yields blew up from Greece to Ireland to Spain and everyone else. The S&P sold off 19% middle of the year. That was a US presidential election year. Go back before that, 2008. What happened? Great financial crisis. We don't need to repeat what happened in 2008. Go back before that to 2004. What happened then? Iraq war, and lots of volatility along with it. Basically, a war and terror that was raging in the Middle East. Go back before that to year 2000. That was dot-com bubble. The point is, and I can go even before 2000 if anybody likes to see. Many of you are probably listening to this are old enough, but quite literally, in every US presidential year, there is mid year volatility, and it's not pretty. And you cannot predict those kind of things either as to what will happen, but they do happen. From somewhere, from some angle, completely unpredictable volatility just sweeps right back in. It always does. Every US presidential election year. And the US politics is always very, very ugly episode of the US. I don't know what's going to happen between now and November, but I would not fully discount the idea that it's going to be smooth sailing from here. And that's why I have this election hedge. Anybody else has any quick thoughts on any of this, or am I just talking nonsense here? Please feel free to jump in.
Data Warrior, haven't heard from you in a little. You got any thoughts here?
So yeah, I do have some thoughts not pertaining to the election. I personally just prefer not to speak about politics publicly. I think that's up to everyone to decide on their own. But I will speak to the butterfly. I love butterflies. Big butterfly guy myself. I trade them all the time. Great way to put on a hedge. I totally understand what you're trying to achieve. My only question would be, if you get the move ahead of time, say in like September, October, that butterfly is not going to materialize as you might want it to, which I'm sure this until you get to that expiration. So that would just be one thing that I would consider. I've been in butterflies a week out and hit my target perfectly, and I'll be down on the trade just based on the change in the volatility, not exactly happening in my favor. Sorry, I have something in my throat.
No worries. Take a second. It happens to me all the time on Spaces. It just is
I can
like that.
quickly answer that. So this is a
Sorry about that.
skip strike. This is a skip strike butterfly for that reason. So it has a net higher delta than a regular butterfly, and I constructed it for that reason only to give myself plenty of room to the downside, even if it slices through all my slides. Let's say we get a 20% correction or sell off in the market, it wouldn't bother me. But your point well taken, because what the max gain on the trade would be would highly depend on how close or far I am to the expiration and what's happening in the implied volatility. Naturally, a VIX at 40, for example, would not help me as much, right? But a decline that is moderate in nature, 10-15% corrective phase in which VIX gets to even the mid 20s and time decay remains in my favor, even if it were to happen in September and October. Maybe not 10x, but I'm still looking at multiple x return on the trade, right? Even in that scenario. So, and again, this is a skip strike, leaving that broken wing to allow me to capitalize on the downside.
Absolutely. Yeah, I love the structure and the ability, to be patient with the trade. And yeah, best of luck. I hope it plays out for you.
But it's
So
really, this is just a hedge. It's really a cushion of, am I the only one who somehow think that there's going to be volatility sweeping in related to election cycle? Or like nobody's concerned here at all at this moment. Like it's just not going to happen when the history is completely opposite side.
No, Jack, I
Ju-
have some January puts on SPY to capitalize on the IV and it being overbought. I actually got into those this week. Right now, it's on the daily and weekly, SPY is way overbought, and I do think we're gonna get that IV pickup. I hate doing this kind of put ahead of July, the month of July. So like, I'm gonna see where I'm gonna go next week or so, but I am gonna be probably a decent size, like 3 to 4% probably SPY puts out in January. Not January, December. December is really cheap right now. January and November very expensive. But I am I do think we're gonna get a 20 handle Jag on the VIX sometime before the election.
So I'm going to pop in here. I'm on vacation, so that's why I haven't talked much. And I also can't hear most people up here except for Jag, Shy, and Wolf. But I agree, Jaguar, because I mean, as the rhetoric, as we get closer, and you're right, you see this every election cycle
Is
for
anyone
different
talking?
reasons.
Because I can't hear
Oh,
anyone
Jake can't hear
yeah,
anymore.
me.
it's
Yeah.
Kim. Yeah,
Okay,
I'll let you know when
sorry.
she's done. No worries. Go for it,
Okay.
Kim.
I know it's weird. The space is really glitching for all of us up here. Long and short of it, I agree with that. What I like to use, and you can let Jaguar know this, is I like to use ES put options, and they're expensive, so I wouldn't be buying, very many of them. I would like hedge it against my portfolio, right? But there's no theta decay, and so that's what I'm going to be looking at. And I've been kind of waiting until July to start putting those trades on. But I agree. I think you're going to get rhetoric. The whole election cycle is going, in my opinion, to be a lot more volatile the closer we get to it. And then I think you have November, December, January, where all we can predict right now is we're not going to have a clear answer. And then if the market doesn't know what to expect, then oftentimes it's down. So I'm not doom and glooming it. I'm not like selling out of my stock positions or anything. But yes, I will definitely be hedging.
I have a couple things on that. First question, Jaguar. So your thesis essentially is that every election year there's been a some type of major event globally that has affected the market. Is that kind of the basis of this? I mean, I heard
My
all the history you
it's
laid out
mid-year volatility. Every
mid-year.
election year, there is a mid-year volatility that sweeps in, and it's always new every time. Something entirely different. That's why what makes it unpredictable. You know, again, 2020 was COVID, 2016 was soft landing, oil crash, 2012 was EU debt crisis, 2008 was great financial crisis, 2004 was war in Iraq, 2000 was dot com. Every time it is different. And if we go to 1996, it was long-term capital management and a currency crisis in Asia. We go to 1992, that was a commercial property crisis basically blew up. You had a major stress that happened at that time. 1988 was not such a bad year, but the year before that was 1987. And you know what happened then? That was the Black Monday. My point is that every election cycle, middle of the year, there is some sort of a volatility shock that happens leading up to the election, and then the certainty comes back in right after election is over. We know who the new leader is going to be. We have clarity on the direction of the policies, right? And then things kind of get back on the smooth, sailing. And that's why overall for the year, S&P does actually okay if you look at for the full year performance, but the middle of the year brings some attacks, some anxieties, basically in the market among investors. We are in that phase right now, and I have no idea what's coming down the pipe.
That's interesting. So I think it would be important to separate the two things. So the what you're speaking of there is mid-year volatility, and then I think a lot of us also have concerns about the actual electoral process itself. So November election day through transfer of power in January. I think those are two separate events that we both events we should be very cautious and aware of, just to separate those two.
Sounds good, guys. Hey, I got to jump here in about a minute for another meeting, but really, really fun having everyone together on this space tonight. Great having you back, Jaguar. Awesome having you on Theta. Been a couple weeks. Kim, Emp, Shy, I know you guys are on all day with me. This is not nearly the end of my spaces this week because I have a pretty full day tomorrow. In fact, I'll be live for live trading at 9:15 a.m. Eastern. Then we've got a space called Hottest Market Takes. It's going to be at 11 a.m. Eastern tomorrow that I think a few of y'all are going to be on. We're going to have, actually, I'm having a pretty fun space at noon with, I had a guy from who works at Twitter jump on last week, and he might come back this week, and we just talked about everything that's wrong with Twitter. And then at 2 p.m. Eastern, I am going to have some stock market predictions, 3 p.m. power hour, and then Friday we're also going to have that savvy trader space at 3 p.m. Eastern. So honestly, a lot more to come here for everybody in the mix. So thank you again to everyone for joining this one tonight. Very much looking forward to the next one, and I've sent out everyone also some invites and stuff for next week if we have spaces that fit your schedule. So appreciate everybody again. Wishing you all a great night. Hope everyone enjoyed this. I'm going to close this one out here and it should become a recording, and anybody that wants to can listen back through it. Take care, everybody. Thanks, Jag. Thanks, Theta, Kim, and Shy.